Welcome to forex-dragons.com educational videos. Our basic introduction to what technical analysis is. We do want to have a look at different indicators that can help us to make the right decisions. One of the few indicators I do work with is the Relative Strength Index, or for short RSI. Let's quickly add this to our chart. A technical momentum indicator that compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an asset. The RSI ranges from 0 to 100. An asset is considered to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and there is a good chance for a pullback. Likewise, if the RSI approaches 30, it is an indication that the asset may be getting oversold and therefore likely to become undervalued. A trader using the RSI should be aware that large surges and drops in the price of an asset will affect the RSI, by creating false buy or sell signals. The RSI is best used to complement other indicators, like the SMA or simple moving average. The simple moving average is a trailing directional indicator. A simple moving average is calculated by adding the closing price of a market for a number of time periods and then dividing this total by the same number of time periods. Short-term averages respond quickly to changes in the price of the underlying market, while long-term averages are slower to react. The crossing of short-term moving averages over or under long-term averages can signal the start of an up or down trend. How you do set up your moving averages is up to you. What is important is that you do experiment with different settings to see what works for you. We have tried a wide range of settings from Fibonacci numbers to root calculations, and for the last 3 years we use the same set of 4 indicators, which are the settings of 20, 50, 100, and 200 time periods. Let me show you how are we going to use those 2 indicators together. Technically speaking, we are talking about 5 indicators, as we use 4 different settings for the SMA. Before we go and add the moving averages, I like to introduce to you a cool new indicator that a Jaina trader offers. It is called Rainbow and works similar to our system. Personally, we have never tried it, but we certainly will give it a try at a later stage. You are able to see that at points where the moving averages meet there is the chance of a market direction change. But let us get back to our own moving averages. We start with a simple moving average, also called a SMA, with a period of 20. This means if I trade in the hourly chart, the average counts every 20 hours of historical price change. This is our fast moving average and we give it a nice red color like a fast car. You can see that when the price crosses the moving average to the upside, we are in an up-market trend. When the price moves below the moving average, the market moves in a down-market trend. As we use a fast-moving average, the trend movements tend to be fairly short. This is why we use several different time periods, as it indicates the short, medium, and long-term trend. So let's add another moving average, with a time period of 100. Now we see the trend over a 5 times longer period, and we can see how this compares with the short-term trend. You can see clearly that the trend moves are longer and not as volatile. This gives us a better chance to use market direction to our advantage. The trend is your friend, is a popular proverb in trading. Historically, the 100 and 200 period moving averages are good points to get in and out of markets, and could be the starting point for your own strategy. You can even combine this with your RSI in a simple automated system. But we do look at automation a lot further ahead. But let's add the 200 moving average to the chart, and look at what happens. In most cases where the market hits the 200 moving average, there is a correctional move. In most cases where the market hits the 200 moving average, there is a correctional move. The higher the time frame, the longer the move. For day trading, the hourly chart is just fine to start off with, but the daily chart will give you longer-term gains. In trading, less is often more, and from the wide range of indicators available, pick 2 or 3 that work for you. You will need 2 or 3 to verify another indicator's signal. The more verifications, the stronger the signal. As this is a YouTube video, we want to keep it short, but do not forget to register on our website www.forex-dragons.com to receive our daily trading signal.